Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. On today's show, we're going to talk obviously about what's happening with the frac spread count, the rig count, but I had a question come to me about what would happen if Biden were to stop U.S. exports and U.S. crude exports. And I wanted to touch on that because there's a lot of things that go into that decision, and it feeds into what does a refiner do? What are we importing, exporting? And I think it's an important discussion to appreciate crude quality and what that would really entail and would it actually work? And the short answer is no, but we'll go through why. So before we get there, we want to talk about the Primary Vision frac spread count, which was down 6. So when you look at why it was down on a national level, again, it was mostly from some of the smaller basins. The Permian held firm, Anadarko, the Haynesville, same thing. So when you look at activity, the Williston slowed just a bit. That's something that is more seasonal. But when you look at activity, and we talked about this in the insights again today, this is usually a point where you have a little bit of a slowdown, and then April, as you come out of April, you start to see a big, an increase. So this is what I would say is kind of the low at this point. And next week we're gonna bounce, and we're gonna work our way back to about 280 by the time we get to the first week of April, or I should say the last week of March, first week of April. So we will start to get to that point, and then by the time we get to 280. We'll see a pretty steady increase towards 290 as we go through April, but that 300 number is going to be difficult to really get above in the near term, and there's really no rush to do so right now, just given where some of this activity is. There's still a lot of supply chain issues in terms of pipe, casing, other. So there's a lot of logistics that have to be worked through, and the E&Ps at this point, when you look at what the activity is doing. They're pulling back a bit, letting the supply chain kind of catch up with itself to make sure that when they do start ramping back up, there will be enough capacity, there will be enough DUC inventory, and we'll talk about the spreads in a minute when you look at the spread between rigs and completion crews. So now when we look at just the activity in the U.S., on the rig side, we were essentially flat. So oil dropped 3, gas picked up 2, miscellaneous 1. But when you look at the breakdown, one of the things we always point to is horizontal versus directional versus vertical, which is at that bottom piece. So when you look at horizontal rigs, we only dropped 1. So it wasn't like we had a huge change on the horizontal front, which is really the key piece for creating the drilled but uncompleted wells. So typically you have kind of the vertical run ahead, then you have don't get me wrong, the horizontal can do both vertical and horizontal, but it just depends on the speed in which you're operating at. So here you can see the horizontal has continued to be strong, remains robust in general, and that was some of the things that we've seen on Twitter and some of the other places in terms of rig count. That's why we want to really show which one are we looking at, because rigs are very important when you're looking at replenishing that drilled but uncompleted wells. And that's going to be the key, because as you go into spring, you have that spring push, and then you pretty much hold firm through most of the summer. You'll have some dips, obviously, for 4th of July, Labor Day, Memorial Day. You'll have some slowdowns on just seasonally speaking, holiday basis. But really, spring and summer is where you're going to get most of your work done. Then things start to slow down a bit as you get into September. Then obviously you have that November to December lull. So seasonally speaking, this is kind of this down move before we get that final push into spring, and then what we get to this level where we think that we would top out at about 325 spreads. It's something where there was a weight on who was going to pay for this. So the oil field service companies were like, look, to the E&Ps, if you want new equipment, if you want me to go out into the yard and take that warm or cold stacked equipment and repair it, I'm going to need a long-term contract, and not long-term in the sense of 4 years, but 6 months or greater in order for it to make sense. Why am I going to bring this back? On the pipe side, guys are not threading pipe until they have their deposit in hand and you get in line, because a lot of the pipe guys, they were left with a lot of this threaded pipe that they couldn't sell into the construction market. So now it's like, look, you get in line. It'll take about 6 weeks to 3 months to thread the pipe, and then it'll be delivered, because they don't want to sit with all of this inventory. So even though the politicians like to say, just turn on the taps, it's like, well, there's a logistical issue. There's supply chain problems. There are things that have to be addressed. You can't just run out and get stuff. Is the horsepower available? If it is available, is it up to speed? Does it need new pieces? Does it need new parts? And that's where we continue to see this back and forth on how quickly we're going to get there. So this is, as we've been saying, the kind of last dip. We think rigs continue to see that grind higher as they continue to replenish ducts, make sure that there's enough inventory to run through the summer, and then we're going to start to see that push. But one of the things when you start looking at, does it make sense for Biden or the U.S. to stop exports? And if we stop exports, then we would be able to hold this crude at home and everything would be fine. But when you look at the average, so this is just looking at refinery inputs. So when you look at refinery inputs, the average API for 2021 was 33.21, which just means that on a weight level, the average was 33.21. So when you look at some of the different pieces, and then on the sulfur side, sulfur was about 1.35. So we're running things that have a high sulfur content and a low API. And that's a problem, because the US, as we'll show in a minute, produces something that is much greater than what is the API level. On average, after running it through a splitter, the U.S. produces the lion's share between 42 and 50. So, but realistically, let's call it 42 to 48. So where are we going to get this crude? Because if we stop exports, that just means that all of this oil is just going to continue to build into storage, but we really can't use all of it. Now, don't get me wrong, refiners since really the shale revolution started have been adding different capacity and different functions, whether that be a hydroskimmer, an alkylation unit, trying to add a reformer to create more reformate. They've been doing things to try to utilize the excess capacity that the U.S. has been developing. But a lot of these processes can't be skipped. Like, you can't skip a coker. You have to build a whole new process, because in order to get into that stream, you have to go through the coker, and there has to be a certain amount of heavy sour, especially heavy crude, in order to make that work. Which is why when you start looking at did the Keystone Pipeline make sense, it would have just been an easier way to bring all of this crude down from Canada and into the U.S. without having to worry as much about rail. Now, don't get me wrong, rail was still going to be the case, but it just would have increased the availability of this heavy sour crude that is so really needed and demanded within the U.S. And it's not just the U.S., it's other areas. Like when you look at India, is built to handle a lot of Urals and Iranian crudes. When you look at China, they have a lot of coking capacity, because when a lot of these facilities were built, it made sense to take the heavy stuff that no one really wanted, because if you do it the right way, especially using cokers, you can handle the sulfur, you can handle these different pieces, and then you can put out a viable product. So India is now the second biggest destination for Urals for March, with 560,000 tons scheduled to arrive at the country so far this month from Russia's Black Sea port. So when you look at how things are shifting, you have to consider that all these different crudes have to move around the world. So when you look at Europe is another big destination for Urals. Some of that is going to go into China, into India, but how are they going to replace it? We've talked about this in the Econ show and in the EIA show, especially on the Econ show segment 1. Where are they going to get it? So when you look at how can they kind of make the mix of Urals, it's going to be Libya, U.S., and either Middle East or West Africa to create that blend that they need, and obviously local European crudes. But they have to replace a significant amount, and they have to try to essentially match that Ural cut by just splash blending it together. So the U.S., which is light sweet, it alleviates some of the sulfur needs, so then they can take some of the higher sulfur cuts from either the Middle East or some of the other ones from around the world, and then use the U.S. crude to kind of blend that down on the sulfur front. But again, trying to manage that. So who would we really be hurting and helping in this? Like, we're not going to help the U.S. by shutting down exports because our refiners really can't use it, and we're already saturated. Like, refiners at this point in time are running max light sweet. We cannot run anymore and create the products that we need, especially because globally speaking, we are short middle distillates. We are short diesel, and we'll talk about that in a minute, which is something that the heavier side that is really demanded. So that's where exports are important, because it helps maintain the natural flow of our crude, and it also helps our allies. And when you look at our allies, you have to look at what are the different pieces. So over 70% of the crude in the U.S. is lighter versus the average of U.S. refining. So 70% of what we were producing in this country cannot be used in this country, or at least has to be blended into the. So all of this oil we can't use it. We can't tolerate it. But we do have people that can. We have people around the world. So look at Asia for an example. So we'll take South Korea. So South Korea typically was a big buyer of Iranian condensate. So what happened? Well, Iran is under sanctions. They could no longer buy that condensate. So now they have to go out and source different forms of condensate. Some of that was going to come from Russia. Some of it comes from Australia, but also some of it comes from the U.S. And when you look at the U.S. side, you can see that we're producing a fairly high cut, of over 20% of our product is condensate. So again, this is also an ally we want to protect. We want to help. And when you look at how this is being positioned, we need to maintain these flows, because when you think about I think it's at 9 million barrels a day on shale production or greater. I think we could be up to 9.6 at this point. But when you look at that 3 million of that is going abroad. So if we were to take that 3 million, could we really use it? And realistically, when you look at pricing, especially when you look at insurance and day rates, our U.S. refiner is going to be incentivized to use as much as possible. And so again, we've kind of reached that point. But when you start looking around the world, you have to look at where Chevron, like just using Chevron as an example. So Chevron offered Angola's Dahlia crude for May 4th to 8th arrival at dated Brent, plus dated Brent $3.55, which is another drop from $3.70. So you're seeing how there's also some of the shakeup in terms of where is the demand coming from. So typically West Africa sells into Asia as well as into Europe. So Europe is in maintenance season. We have to wait for them to come out to see how active we're going to get within West African flows. But China is looking to buy discounted crude. So they've been buying more from Iran. They're going to buy more from Russia, and that's going to leave more of this West African crude in the water, which can then be purchased. But this is actually decent crude because it has a fairly high middle distillate cut, but it is priced against dated Brent, which is very rich versus Oman, Dubai. So when you start looking at, the U.S. can just ban exports, it's like, but what kind of oil are we talking about? Because it's very specific. But it's not going to stop the way things are happening in the U.S. because, there's this pushback of like, the U.S. needs to just stop its belly aching and increase production. Just get past what has happened on a political front and just try to make money. It's like, but there's been a lot of neglect that has happened since 2020 when you had the collapse of output, you had COVID hit. A lot of these spreads went to the sidelines and then they slowly came back. A lot of E&Ps just tried to maintain their decline rate or at least protect their decline rate because you didn't want anything over 20% because then the uphill battle was going to be massive. You wanted to maintain 10 to 13%. And then in 21, try to work through that excess DUC capacity and kind of build back. So I shouldn't say build back because then it sounds like build back better. But let's just say build back their production levels. So and do it in a cost-effective way. So one of the things we've been talking about is the spread between where are rigs and where are completion crews. So one of the things we've been saying is that completion crews were going to slow down a bit. and you're going to have rigs continue to take off. So when I think we wrote the article August of 2021, where we really said that there was a big supply chain problem and it was getting worse, not getting better. And that's why when you hear just turn it on, it's like, okay, well, who's going to help me with my logistics? So that's where when you look at this slowdown on rigs versus spread, so this bottom one, this green cloud here, you can see that rigs have really started to ramp up as completion crews slow, again, allowing logistics to come through, allowing some of this catch up. We do expect some of this to kind of come back and just stay at what you can see is fairly normal. Look at 2017, 2018 levels. We had a spread of about 0.45, 0.47. So, but typically you kind of get this slowdown and then you get this ramp up where rigs are going to keep running, but you're just going to get the pace of frac spreads coming up and kind of just accelerating a bit, which again is going to bring that spread higher. But that's going to be an April event. That's going to be an April and May event, not a March event, which again is that seasonal slowdown. So just to kind of put it in a pretty graph form, the next question was what happens with Canadian crudes, West Texas, West Canadian Select. So that's when you're going to go to essentially the very left. When you look at what they are, it's anywhere between 13 and 17 API. With a sulfur content of just over 2.5%. So you're already all the way to the left at the higher end. But when you look at Urals, you can see Urals are sitting there right at about 32 with a sulfur content of about 1.5. But then look at Iranian light, Iranian heavy. Where is West Texas in this? Like look at WTI Midland all the way to the right. When you see us, we're at about 0.75, 0.8 on the sulfur scale and about 43 API. So what is that? What are we really going to do with that? When you think about what we're built to take Mayan, we're built to take, Middle East heavy sour. So if we were to kind of lock it back, but if we did take down a significant amount of that Canadian crude, well, then if you take that Canadian crude and then blend it with WTI, that's going to put us in a much different place, because then you're going to be something much closer to, let's call it 33, which would be ideal, with a sulfur content that would be much closer to about 1.75, which is almost right on the money on where we need to be. Not to say that we could do that with the full amount, because the U.S. production, your refining capacity is close to 17, 18 million barrels a day, with a current operation of closer to 15 to 16, depending on seasonality. It's probably much closer to 17 at this point, given some of the shutdowns. But again, we're right between 15 and 16 million barrels a day of refining capacity. So, we're producing 11.8 million barrels a day. But a lot of that is the light sweet, so we'd have to blend it, but we'd still always be beholden to the export market. So again, we would just kind of complicate the storage situation. But if that were to happen, we would try to bring down as much Canadian crude as humanly possible, which would then bid up Canadian crude. We would then have differentials tightening, because we would rush to say, okay, well, we can't export this oil, so what are we going to do with it? And we're going to try to go and get the heaviest crude possible to create these blends. So again, there's a lot of those nuances. Now, private refiners in Shandong, as we've been saying, they've cut runs significantly. It's the deepest cut in 5 years. They're down to 50.56% operations as of March 17th, which is down another 5 percentage points from the previous week. And it's a mixture of just where is storage onshore. They're fairly comfortable, just at about 50% utilization on the product side. But it's the lockdowns. And it's not just because there's a slowdown in just activity, it's also logistics. And that's where we continue to see some of these problems. So then when you think about logistics and you think about some of these shifts, you can look at Singapore. We were saying that we were going to be fairly flat in terms of just the build in Singapore. We had a small build of 200,000 barrels, which was driven by light and residual. But middle distillate continues to have these draws. So light distillate is the one on the gasoline side. We remain a bit bearish on gasoline, but diesel's the bullish spot. We continue to see that demand. And then look at Europe. One of the things that we've been talking about, and we discussed in the Econ segment 1, England is just getting blown apart. I mean, Europe is getting blown apart on price, and you're seeing that really start to show up in the gasoline demand numbers. So it's not really surprising to see gasoline inventories spike so much. And that's going to be one to watch, because I think they're really going to have to start exporting a bit more in order to keep that gasoline balanced in Europe. And you're seeing something similar in Singapore as emerging markets also slow down due to just the price of goods and the price of just petrol, which is going to be the biggest issue for that demand function. But the gasoline front, the world right now is fairly long gasoline, but we really need more of that light distillate, more of that diesel, which is why we should see more of those medium grades getting picked up. And that's going to be why the U.S. is going to continue to be pulling down some of this excess. But then when you start looking at congestion and where things are, so when you look at TomTom on the congestion side, you can see that there's been a fairly big rollover, and we'll talk about China in a minute. But the biggest component for what we're seeing is on Europe and North America. But we want to see how this progresses, because for those that are in the South or in other areas, this is spring break. So typically we see some of these increases, which we saw with Google Mobility in some areas, but it's starting to roll over. And Europe is the one where we're seeing it roll first. But if you consider pricing, it makes sense for it to be Europe first, just based on the consumer never recovered. They were already in a tough spot prior to everything else. So they were already struggling in terms of the pricing. They have yet to see any type of real recovery. So it makes sense for Europe. The U.S. had recovered a bit more. The consumer was in a different place, but now they're starting to roll over. So again, we see this as the demand destruction is continuing, but it's not just because of the price of oils, the cost of food. Diesel, like one of the things that we were talking about, and we discussed it in Insights, diesel prices are $1 higher today than they were in 2011. I mean, you're looking at these big shifts, and I just go to 2011 because of the Arab Spring and the price of food. So we're just seeing so many different price increases, which is why we do expect to see demand destruction, even though there is some different talks. But we're talking globally, because the U.S. demand destruction, as we discussed in the EIA show segment 2, is not going to be this big drop, but more along the lines of things just not going up as much, just along a seasonal level. It's just we're not going to see the same type of rally, just kind of a flattening. Now when you look at China, you can see that pretty steep rollover as we have COVID essentially ripping through the country. We expect to see a continuous decline, and the consumer is also not in a great spot in China. So again, there's just all of these pressure points. Emerging markets, something similar, and as we said last on the EIA show, some of these emerging markets are starting to raise prices because they just can't afford to maintain the subsidies. And here's some of the other problems. When you look at electronic trading, we're watching volumes come down because a lot of the exchanges are increasing margin requirements, and some people are like, look, volatility is just too much. I can't trade in the size I used to because I need to be able to manage the volatility, manage my margin calls, and that's resulting in some of these slowdowns. And this is just one example of the margins for Europe's diesel futures have continued to surge. Now, just one of the last things, because all of that leads to inflation, is just looking at where the Fed sees us going. And when you look at the dots, because everybody loves their dots, and when you look at the median, you can see that they're putting us right at about 2.75%. So if you've heard me talking about this, one of the things I was saying is that the natural rate, and the natural rate is where should rates be naturally, is at about 2.75%. That was what I had said. Now, I think rates need to go higher, and Summers was out saying 4 to 5% in order to bring inflation under control. There is zero chance the Fed has the ability to get there without causing a massive panic, even though that's probably what should happen. But this is why we were saying that natural rate is at about 2.75%. You can see that the Fed funds futures, which is where you can kind of take bets on this, still don't believe it. I'm not really sure why, but you can see that it has increased on 2022. where the initial view was at 1.75%. Now they're saying it's going to be at 2% in 2022, but then essentially have fairly slow increases as we go through 23, where the Fed is looking at something a bit higher, with long-term rates still coming back below 2.5%. Regardless, they're going to have to try to get in and get in front of inflation. They're going to have to try to get in front of rates. I do think at this point that if things continue at this pace, it is likely we'll see a 50 basis increase in the next meeting. My view is that we would have 25 basis points, but given inflation, where things are, some of the components that we've talked about so far, it'll be difficult to see them not have a bigger increase. So that's what we have for you today, trying to keep it a little light on Russia because we covered it a lot this week in both the EIA show and Econ show. Again, if you have any questions, you can find me on Twitter, or you can find me in the comments section. So hopefully everyone has a great weekend, and thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.